So today is December 8, 2023. And today, one of the discussion we are like, as an investor, what we should be looking and how we should be taking care of our investments. So number one thing is, see, think like this, our money is actually a limited resource that you have. Well, and with all disclosure, like, you should not be putting money which you cannot afford to lose. Number one rule of the business is you don't want to lose the money, but at the same time, you should not be using your 401k retirement money. So where you are, so number one thing, once that is taken care of, the second part is growing your money. In that case, how much risk are you planning to take? If you are taking a low risk, in that case, invest into S&P 500, all the blue chips. They will give you absolutely 8 to 10% or 12% and a decent return with lower risk. One with the medium risk is when you are putting money in somewhere between 10 billion to 50 billion net worth company, which have more better rate, where money can go up and down. You have to, but their buying cycle becomes very important. At what prices you are buying? If right now, most of the money, if you see, is buying into the derivatives, where you can plan to buy a stock, use controlling your derivative. And then in market, what they are doing is, earlier they will push market in one direction, and then there will be sellers and they will make money buying and selling position on the derivatives. What has recently happened is market has become bidirectional. It goes up and comes down sharply on that medium cap category. The blue chip cap category is still unidirectional. So they are just buying a long call or buying stock. It makes sense. One of the reason is the blue chip represent major percentage in our S&P 500, which represents US economy. So it has a factor rate where it is represented in the international community. So for that reason, blue chips have been safer. But at the same time, medium cap companies, and they potentially offer you better ROI, return on investment, as long as you're knowing what you're doing. Okay, so like taking stop losses, here your investing skills come into picture, taking stop losses, taking profits, and then reinvesting or looking for so most of our swing traders, our focus is where we enter at the right point and exit at a so swing trading is the medium cap company, like buying and trading a medium cap company is very similar to buying derivatives on a large cap company, because there the movement will be like that. For example, if you're buying an Apple stock at, let's say, $180 going to $190, $10 difference, it may take 2 months, a month and a half. But if you're taking a derivative like an option at 180 and it has to go to 90, so basically what happened is $2 option went to $10, almost 5 to 6 times. As long as you're managing your risk, and the upside is good. So, and that's where market right now is doing. What they have done is the money flow has been from institutions where they are directing the stock to one direction and using on derivatives. The stock investment is comparatively has become secondary on the blue chip, because they have already become so much big. So whereas when the high risk will be when we are trading with companies less than $10 billion, or between 10 to $10 billion. The biggest problem with these companies are their cash management, and the management, all of the and management and growth. And so coming back to company like what we are discussing here, like Applied Optoelectronics. This company was, when we invested in this company, it had a decent return, but if you see, it was in a bearish pattern. So in a bearish pattern, what happens is the stock is tend to go down. What we were doing is, when we did research and looked at the earnings of Applied Electronics, what we found that the company is doing good. It's in a tech industry. Tech is good. As long as it starts to getting at like positive earnings, positive EBITDA, positive gross margin, and market, then the stock has to go up. So it takes some level of research to get into that, and that's what, as a value investor, as an investor who is looking for good upside return, would be looking to do. So we entered near close to $2, and actually we started entering near 3.5, and then it went down a little bit. We kind of were selling covered calls, and after some time, near 2.3 to 2.5, we had an average down, and we just let one of the portfolios just go sit on it. When the stock started to go up, it came close to $8 or $9, and then we were like, okay, what do we do? And then we started selling some of it, but then reacquiring at the weakness, and close to 12.5, where we saw it take some profit. And then now what we are currently doing is, because at a point where it's thing like this, for the position that we have, roughly we had 6,000 stocks here. What we did was, now we cannot acquire 6,000 stocks or hold 6,000 stocks at this particular point. So what we did was, we reduced our risk by going into derivatives mode. And now we are playing with $2 to $3 and then rolling. So I am personally there, but it's no longer, because I don't know the direction as of today. The stock may go down quickly or go up. So for that reason, to reduce my risk, I have to go to the derivatives mode for this particular stock. Whereas, so you increase. So I took a high risk stock position, made profits, and then what I did was, I'm reducing my risk by going into derivatives, because derivatives, you can only lose so much. And as long as you know what you're doing, then that can come in your favor. So it was that's something I wanted to show. Risk management in investment is the name of the game. Had I known a company that will never go down, I'll just put my money in stocks and just forget it. But since this does not happen often, and you want to take profits and then reinvest your profits, we want to go to the route where we can optimize our investments. So low risk, medium risk, high risk. Okay, in a low risk blue chip, the cost of the stock is, let's say, above $150. In that case, buying number of stocks will be limited. Another part, I tell my clients, is $150 stock, where if it's an Apple selling off close to, if it's $180 stock, coming to 150 will take a lot of time and effort. There has to be some major reason. But another company, like say a $150 stock, let's say furniture store, restoration hardware, for that company to go down, it will be rather quick, because they are their earnings may fluctuate. It is simple. If you see, and we discussed this yesterday or 2 days back, we were expecting restoration hardware to go down. I mean, in fact, we discussed this, that after earning, restoration hardware may feel weakness, because the industry is shifting because of high volatility. They are reducing their spending. And yeah, this is what exactly happened. And it had good appreciation as well. Let's say it went here, but I was expecting it to feel some level of resistance and come down. So, for example, Restoration Hardware versus Apple. Now, chances of Apple making such a big drift like down drift will be less. Now, number one, Apple, to increase our still in a stable position, you can optimize your investment from low risk to high to medium risk, where you can trade the derivatives like options and all. So that's one way of doing it. For a Restoration Hardware type of position, again, derivatives help it, but it's already not a low risk. I consider any stock which has a high volatility to fluctuate on its earning is, even though it's more than $150 and all, it is still medium risk or maybe medium to high risk. So managing that becomes an important element that we want to take care. And derivatives can be used to increase your risk or decrease. In case of Apple, you are increasing risk because it's already a low risk stock. If you're going into derivatives mode, you're increasing your risk. In a Restoration Hardware case, let's say it's a little bit medium to high risk, where you're playing your derivatives are actually reducing your risk in a way. So that is one way of investing. Another important factor is the time horizon. If you know that you are playing and buying at the right time, certain times where you just buy and hold. For example, Chipotle. Chipotle has not seen a weakness. I mean, for a very long time. It's been, if you had invested in Chipotle, we had, let's say, so even before 500. Now, Chipotle was close to sub of this, but it's been going down and up. See here what the performance of Chipotle has been. Near at this level, $280-$90, when it went from 600-700 to all the way close to like 200-300 level. We were bullish, but at that time we were relative to $700. Right now, where it is $2,200. No reverse split, no splits, no dilution, just regular business. It went through COVID, and after COVID as well. The business moat is strong. Their revenue, market cap, marketing strategy, things have been placed well, and that's where the stock has significantly outperformed S&P 500. So think like this: having not too long, I'm just talking about, let's say 2018, having have invested close to $300 per stock. Right now, we are looking close to 5,000%. So every year, if it's five years, this stock has performed close to 1,000% every year, way outperforming S&P 500. So as an investor, if you know where you are entering, so in this stock, if you are entering and you exited here, you kind of let go a good amount of profit. How could you have reduced? You took profit here, thereafter move to derivatives, where you think, okay, now I don't know where the stock here is going to go up further. We all speculative. So being in derivatives let you ease, you not using a lot of your money, reduce your investments, and just play like that. Let it go up. If it goes up, if it goes down, just you're not losing. Your emotions are not as much involved because your risk of loss is lower. So that's the way an investor should be thinking, how related to their investment. So, I mean, this is my thought process. So Gautam, any question, any thoughts?
No, that's good information. No, I'm listening.
Yeah. So again, see, think stock is one instrument. Stock when it's going up, it is one of the best tool because it has a delta of 1, like options. Whereas if it's going down, it's extremely risky as well. So for that reason, whereas in case of a derivative, when it goes up, delta is close to 0.5 to 1, and if it's going down, then the delta is between 0 to 0.5. So where your risk is lower, as long as you know what you're doing. And it's the biggest disadvantage of a derivative is you can lose your premium, but people mind get stuck to premium, where like, so that's how you manage your premium is a skill we do it on the derivative side. So I mean, I'm talking about risk management and invest and grow your investments. So okay, so hopefully that would be helpful. If any questions related to that, feel free to just message us. Okay, thank you.
Thanks, Avinash.